The price of silver just stopped making sense. On one screen it looks calm, controlled, almost boring. On another side of the world, buyers are paying prices that shouldn't exist. Here's the contradiction. Western markets are still telling you silver is cheap. Eastern markets are acting like it's running out. Both cannot be true at the same time. And this isn't just about metals or traders. This reaches you directly, because when prices disconnect from reality, it's never the chart that pays the price. It's purchasing power, savings, timing. Right now, there's a growing gap between what silver costs on paper and what it costs to actually touch it. Not cents, not noise. A gap so large that in a normal system, it would be erased instantly. But it isn't closing. That tells us something is broken underneath, not temporarily, structurally. And notice this part carefully. Nobody is officially calling it a crisis. No alarms, no emergency language, just quiet screens pretending everything still works. So here's the question you need to sit with. If the price you see can't buy the real thing anymore, what exactly are you looking at? Because when paper prices collide with physical reality, the system always chooses a side. What's happening didn't start today, and it didn't start with silver. The visible event is simple on the surface. Prices that are supposed to move together are drifting apart. One market says abundance. Another behaves like scarcity is already here. But this isn't a one-off glitch. It fits a pattern that's been forming quietly across commodities, currencies, and even energy. Here's the key framing. For decades, global pricing has been built on paper promises, contracts, IOUs, claims on future delivery. As long as nobody asks for the real thing at the same time, the system looks stable. But now demand isn't behaving normally. Buyers aren't asking, what's the price? They're asking, can you actually deliver? That shift changes everything. Because when markets move from speculation to possession, pricing power moves with them. Screens stop leading. Inventory does. Notice what's missing from most coverage. Nobody is asking whether the traditional pricing centers still control discovery at all. They're still treated as the reference point, even as more transactions happen elsewhere, under different rules. So this isn't just about a metal, it's about who sets the price when the old referee can't enforce the rules anymore. And once that question enters the market, it doesn't leave quietly. There's a strong claim forming beneath all of this, and it's uncomfortable. The traditional pricing system is losing control of the physical market. What we know for certain is this. In China, buyers are paying triple-digit prices for silver. Trades have been reported above $100 an ounce, with peaks around 114. At the same time, U.S. futures markets are still pricing silver more than $10 lower. That gap is not theoretical, it's persistent. In a functioning global market, that difference should vanish almost instantly. Traders would buy where it's cheap, sell where it's expensive, and the spread would collapse. That's how price discovery is supposed to work. But it hasn't happened. What that suggests is more unsettling. The bottleneck isn't information, it's access. Paper contracts can change hands endlessly, but physical metal can't teleport. When demand shifts toward immediate delivery, paper liquidity stops mattering. Here's the detail most people glide past. Eastern buyers aren't chasing a chart. They're bidding for metal they can actually receive. That behavior only appears when trust in paper pricing weakens. Now notice what's missing. There's been no clear denial that physical supply is tight, no reassurance that inventory is abundant, just silence and business as usual language. And that silence matters, because if the system were truly balanced, this gap wouldn't survive a single trading session. So the question changes. It's no longer why is silver rising, it becomes why isn't the gap closing? And once you ask that, the next phase is already underway. This is where the story stops being abstract and starts accelerating. Because once a pricing system loses control, the next move is always escalation. Not a reset, not a confession, escalation. Historically, when markets face this kind of pressure, they don't admit failure. They change the rules quietly, incrementally, in ways that look technical but function like barriers. You've seen this pattern before, even if you didn't recognize it at the time. When volatility rises, access gets harder. When delivery risk rises, costs rise with it. Not because supply suddenly improved, but because participation needs to be discouraged. And here's what should feel abnormal. A market built to handle global demand is now behaving defensively. Measures that were once emergency tools start looking permanent. Restrictions become normalized. This is the dangerous phase, because normalization dulls reaction. What would have caused outrage a few years ago now passes as routine risk management. Notice how language shifts. Instead of talking about scarcity, the focus moves to orderly markets. Instead of delivery, the emphasis moves to financial settlement. The product doesn't change, the expectations do. This is how systems buy time. But buying time isn't solving the problem. It's stretching it. And stretched systems don't snap gradually. They fail suddenly, which raises the next question. If pressure keeps building and the old mechanisms stop working, what's the next lever they pull? Now the evidence gets harder to ignore, because while markets talk about stability, actions tell a different story. Institutions that normally sell without hesitation are slowing down, pulling products, or quietly stepping back. When sellers hesitate in a rising market, it's not because demand disappeared, it's because replacement risk just became real. Here's the contradiction that changes how you see this. On paper, silver is liquid. In reality, physical supply is being treated like something you don't casually give up. Some sellers would rather wait, reprice, or not sell at all than exchange metal for cash that may not buy it back. That behavior doesn't show up in charts, but it shows up in availability. Now watch how fast this flips. The system says price discovery is working, yet the very entities meant to distribute supply are acting as if today's price is already outdated. This is the moment people miss. When price rises scare buyers away, markets cool. When price rises scare sellers away, markets break. And that's exactly what this looks like. Notice what isn't happening. There's no flood of new supply rushing in to meet demand, no relief valve, no sudden abundance, just delays, pauses, and quiet recalculations. That's not confidence, that's caution. And once caution spreads from institutions to everyone else, behavior changes permanently. Buying becomes defensive, selling becomes strategic. At that point, price stops being the signal, availability does, and that leads straight into the next pressure point where multiple stresses collide at the same time. At this point, the pressure doesn't come from one direction anymore. It stacks. First, physical demand keeps pulling metal out of circulation, not for trading, for holding. Once that happens, it doesn't come back quickly. Second, pricing mechanisms tighten at the same time. Costs rise, access narrows, participation becomes more expensive, more technical, more selective. That's not an accident, it's a filter. Third, uncertainty accelerates everything. When nobody knows where the real floor is, hesitation disappears. Decisions get rushed. Timing matters more than price. Put those together and control starts slipping, not in a dramatic collapse, in a series of small losses of grip, each one manageable on its own. All of them together, not so much. This is what loss of control looks like in real time. The system is still operating, trades are still clearing, screens are still updating, but the margin for error is gone. And here's the dangerous part. Once a system reaches this stage, it doesn't need a shock to break. It only needs continuity, pressure plus time. So ask yourself this: what happens if demand doesn't cool? What happens if sellers stay cautious? What happens if pricing tools stop influencing behavior? Because if this continues, the next phase isn't volatility. It's a shift in who holds the metal. This is where it stops being about markets and starts showing up in real life. Because when pricing breaks at the top, the effects don't stay there. They move down quietly into everyday decisions, into timing, into what you can and can't afford to replace. If you're an ordinary buyer, the change doesn't announce itself. You just notice things are harder to get. Premiums feel higher, availability feels thinner, waiting lists appear where there were none. And the explanation is always vague. Shipping delays, inventory cycles, temporary shortages. But stack those temporary issues together and they stop feeling temporary. Now put yourself in the middle of it. You're not trying to trade, you're trying to preserve value, or plan, or lock something in before it moves again. And suddenly the question isn't, is this expensive? It's, will this still be here? That shift hits trust, not ideology. Trust, because when access becomes uncertain, people don't wait for clarity. They act, and when enough people act at once, scarcity becomes self-reinforcing. If this feels familiar, say so in the comments. Not because this is new, but because you've seen versions of this before. In housing, in energy, in food. First availability tightens, then prices jump. Then explanations arrive too late. And once that pattern locks in, it rarely reverses quickly, which brings us to the deeper mechanism that allows this to happen in the first place. What allows this to happen isn't panic, it's structure. Modern markets aren't built to prioritize delivery. They're built to prioritize flow, volume, liquidity, optics. As long as trades clear and screens update, the system is considered healthy. Physical settlement is treated as an edge case, not the core. That works only when trust is high, because the real leverage isn't metal or money. It's expectation. As long as participants believe they can convert paper into reality later, they don't rush. They don't test the system, they play along. But when confidence weakens, incentives flip, holding becomes rational, delivering becomes risky, and institutions respond the same way people do. They protect optionality. Here's the unsettling insight. No single actor has to manipulate anything for this to unfold. Each decision makes sense on its own. Raise costs to reduce volatility, delay supply to manage exposure, settle in cash to avoid logistics. Individually, these are safeguards. Systemically, they hollow out trust. So the story isn't about villains. It's about a system optimized for appearance over resilience. And systems like that don't break when challenged. They break when relied upon too heavily, which leaves us staring at the next question. If this structure can't absorb continued pressure, where does the pressure go next? From here, the future splits, but neither path is calm. One path looks orderly on the surface. Prices continue rising, but slowly. Controls tighten, access narrows, participation becomes concentrated. The system adapts just enough to survive, but not enough to feel normal. In this version, you're told everything is working, even as fewer people can actually touch the underlying asset. The other path is messier. Pressure builds faster than controls can adjust. A single event forces the issue. Delivery delays, forced settlements, sudden repricing that happens off-screen before it shows up anywhere official. Not a crash, a jump. And here's the uncomfortable truth. Both paths point in the same direction, toward fewer sellers, toward stronger holders, toward a market where price reacts after reality, not before it. Notice the uncertainty baked into this moment. Nobody rings a bell, nobody announces the shift. You only recognize it after behavior has already changed. That's why the next move matters so much, because it's already forming. In procurement decisions, in inventory choices, in quiet reallocations you don't see reported anywhere. The market hasn't chosen its path yet, but momentum is no longer neutral. And once momentum leans, it doesn't ask permission. there's one insight that ties all of this together, and it's easy to miss if you focus only on price. This isn't a story about silver going up, it's a story about confidence going missing. For years the system worked because nobody questioned whether paper claims could become real assets later. That belief was the glue. Once it starts dissolving, everything else follows. Gaps appear, behavior shifts, control fades quietly, then all at once. The moment you're living through isn't loud, it doesn't look like a crisis. It looks like normalcy with strange exceptions. Prices that don't converge, sellers who hesitate, buyers who stop waiting, and that's the tell. Because real transitions don't announce themselves. They reveal themselves in friction, in delays, in the growing distance between what's promised and what's delivered. This story isn't finished, it's unfolding, and the next layer goes deeper than metals, deeper than markets. It touches how value itself gets defined when trust runs thin. If you want to understand where this is heading before it becomes obvious, follow and subscribe. We'll keep pulling this thread one layer at a time.